Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. A critical inflection point arrives as AI profitability concerns shake tech giants. The market is slipping as the era of growth at any cost ends. Are you on the right side of this pivotal shift? Second, Nasdaq vs Wall Street. The 24-hour trading war ignites. Insiders are calling it literally the worst thing in the world, warning it could gamify the market and unleash algorithmic predators. Is this the future of trading or a prelude to market chaos? Finally, solar industry bloodbath looms as a critical tax credit vanishes. A mad rush is triggering chaos and threatening to wipe out small installers, but a hidden loophole has sent one giant stock soaring 75%. Who is winning this war, and what's their secret? Markets are on edge. Investors brace themselves as AI profitability concerns shake tech giants to their core. I'm telling you, this is a pivotal moment for your portfolio. The S&P 500 slipped 0.31% to 6,796, while the Nasdaq edged down 0.2%. All eyes are on the tech sector as it faces a critical inflection point. So why should you care? The era of growth at any cost is coming to an end, and the market's laser focus is shifting towards profitability and capital efficiency. Broadcom's shocking 17% decline over just 3 days, triggered by margin compression warnings, signals a broader reevaluation of AI infrastructure investments. The Fed's recent decision to potentially halt rate cuts adds another layer of complexity, leaving investors questioning the future path of interest rates. Let's break it down. At the policy level, the Fed's December cut to 3.5% to 3.75% might be the last for a while. Unemployment is at 4.6%, but with internal Fed dissent and inflationary pressures, the central bank seems cautious about further easing. Money flows reflect this uncertainty, with elevated volatility and capital moving from high-flying tech stocks to defensives and cyclicals. Valuations are under the microscope. Tech's high P, E ratios are being scrutinized, and sectors like financials and healthcare are gaining favor as safer bets. Listen to me. The strategy is clear. Reduce exposure to semiconductor and infrastructure players like Broadcom and pivot towards AI software and applications. The tech sector's internal divergence offers a tactical buy on quality names like Nvidia, while financials and industrials promise more stable returns in this climate. Now, let's dig deeper into today's sector dynamics. Financials are showing resilience, with JP Morgan and Goldman Sachs gaining over 3%, driven by strong net interest margins. The financial select sector SPDR ETF XLF is a bright spot, up nearly 3% as higher rates boost bank profitability. Meanwhile, tech stocks like Oracle and ServiceNow are under pressure. Oracle slid 2.6% on AI debt concerns, while ServiceNow's potential acquisition news sent its stock tumbling 11.6%. Here's the playbook. Good advice makes you rich. Bad advice costs you a fortune. Listen to me and act now. Short term, if the S&P 500 dips below 6,700, deploy cash into quality tech names like Nvidia. Medium term, overweight financials and healthcare by 5 to 8%. XLF and XLV are your go-to ETFs. Hedge your bets with puts on the semiconductor ETF, SOX for downside protection, especially if Broadcom's woes spread. For the more cautious, maintain a 10 to 15% cash position as dry powder for market dips. If the 10-year Treasury yield stays above 4.5%, it's a signal to lean into safer income-generating sectors. Advanced investors consider option strategies to capitalize on volatility, covered calls on high flyers, and protective puts on risky tech. Time's running out. The next major catalyst is the December 18th CPI data release. If inflation remains sticky, tech stocks could face more pressure, while financials might thrive. Keep your eyes on Tesla's Q4 delivery report early next year. It could shift momentum in consumer discretionary plays. Follow this framework to navigate the turbulence ahead. Now let's dive into today's critical market dynamics. A major Wall Street trading desk just called a new proposal literally the worst thing in the world. The plan comes from Nasdaq, which is pushing for SEC approval for nearly 24-hour stock trading 5 days a week. If approved for a 2026 launch, the market would expand from 16 to a staggering 23 hours daily. Nasdaq's move is a defensive play to capture trading flow from Asian and European investors. But this is where the situation takes a more complex turn. The goal is to reinforce the US as the central hub for global equity liquidity. If it succeeds, it would strengthen the US dollar's role in global finance. If it fails, the power to price global events could shift to exchanges in other time zones. While Nasdaq and brokers like Robinhood see this as responding to global demand, critics are sounding the alarm. The Wells Fargo trading desk, in a note to clients, claimed the move single-handedly gamifies the stock market even more than it has already become, calling it the epitome of making trading even more like gambling. And that concern about gamification isn't just talk. Believe it or not, there's research backing this up. The average time people hold stocks has been plummeting, pointing to a broad shift from long-term investing to short-term speculation. This increases portfolio risk, especially for less experienced investors, and could spark a social and political backlash against market operators if things go wrong. But the pushback goes deeper. Jay Woods, a former NYSE market maker, warns this strips away the crucial downtime companies use to release news without sending shockwaves through the market, stating, "You're opening up a new can of worms." What really brought this to a head was the concern over eliminating this overnight quiet period. It creates what experts call information asymmetry, a situation where pro traders with sophisticated algorithms can react to news in seconds, long before retail investors can even digest the information. We can actually measure this by watching the price gaps between the night and day sessions. If those gaps widen, it's a sign the market is becoming less fair for everyone. The core conflict is that while supporters want to let investors trade on global news anytime, opponents fear it will worsen the market's biggest problems: thin liquidity and sharp price swings. Critics point out that most trading volume already happens around the market, open and close, making a longer day counterproductive. Liquidity is just how easily you can buy or sell an asset without its price moving dramatically. The 24-hour foreign exchange market, for instance, has enormous liquidity with over $9.5 trillion traded daily, which keeps it relatively stable. The fear is that a 24-hour stock market won't have that same volume overnight. When liquidity is thin, it creates a much higher risk of flash crashes, those sudden severe price drops that can undermine the entire market stability. Furthermore, this could disproportionately hurt smaller and mid-sized financial firms that can't afford the massive costs of 24/5 operations. This could lead to more industry consolidation, where a few giant players control everything. Interestingly enough, major industry groups have pointed out that current demand for after-hours trading is tiny data from late 2024 shows that less than 1.5% of total volume happens in the early morning, late evening. This directly challenges the idea that there's huge investor demand for this change. The New York Stock Exchange is also pursuing its own extended hours model, setting the stage for a fundamental battle over the future of trading. The push for constant market access is now in direct conflict with warnings from insiders that it could destabilize the entire system. Speaking of structural shakeups that could create winners and losers, let's shift our focus from Wall Street to Main Street, where a similar high-stakes battle is playing out in the US solar industry. A mad rush is on as homeowners scramble to install panels before a critical 30% federal tax credit vanishes, a credit worth thousands on an average project cost of $37,000. This isn't just a minor discount. The 30% credit, known as the Solar Investment Tax Credit or ITC, has been the primary engine of residential solar growth. Research from Energy Sage shows that with the credit, the average payback period for a solar system is about 7 years. Without it, that payback period could jump to around 10 years. That 3-year difference is precisely why everyone is rushing. This isn't a small ripple, it's a tidal wave. After legislation passed to end the credit, one solar marketplace saw a staggering 205% year-over-year surge in homeowners contacting installers. But this flood of demand is hitting a wall. Permitting offices and utilities are now, in the words of one industry director, totally overwhelmed. The lead time to secure a permit has doubled in some regions, putting thousands of homeowners at risk of losing their credit through no fault of their own. And this isn't just a temporary surge. It actually exposes a long-term structural weakness in the US energy system, something experts call the last mile drag. For example, even before this rush, national lab data showed the median time to get a utilities approval for interconnection was 50 days in California. This local friction has always been a bottleneck, and the current rush is simply making it snap. We're seeing this massive demand spike while at the same time the supply chain is getting choked off by US trade policy. Due to the Uyghur Forced Labor Prevention Act, or UFLPA, US, customs have been detaining large quantities of solar panel components from China. This directly impacts the Chinese market as it's a major producer of polysilicon. Data shows that in response, the share of global polysilicon production from China's Xinjiang region has already dropped from 41% to under 25%. This geopolitical friction is creating real-world delays and cost increases for American installers, right when they need parts the most. For industry veterans, this chaos feels eerily familiar, reminding them of the bloodbath of 1985 when a similar tax credit was cut. Back then, one trade group saw its membership plummet from 670 companies to just 37 almost overnight. The reason this history lesson matters is that some projections suggest the end of the current ITC could trigger a 40% reduction in residential solar installations over the next 5 years. To grasp the scale of that previous collapse, archival reports from the Washington Post show that after the credit expired in 1985, the market simply evaporated. The question is whether the industry is mature enough to avoid a repeat. A solar executive warns there's going to be a lot of people that when the music stops, they're not going to have a place to sit. But while small mum and pop installers face going out of business, not everyone is losing. Now, get this. The legislation that cut the residential credit preserved it for commercial projects and third-party ownership models, like leasing. One major player, Sunrun, successfully lobbied for these protections. The result? As smaller competitors struggle, Sunrun's stock is up about 75% year over year, and it expects to pick up more market share. The legislation created a crucial loophole. While the credit for homeowners who buy their systems is ending, the commercial credit, Section 48, remains. This can be used by companies that own the panels and then lease them to homeowners. These are called third-party ownership models. This fundamentally changes the business from selling a product to providing a financial service, and Sunrun, already a giant with nearly a 20% market share, is perfectly positioned for this shift. The end of the tax credit isn't just creating a short-term crisis, it's fundamentally reshaping the entire industry. The pendulum is now swinging aggressively toward leasing models, concentrating the market into the hands of larger corporations. The real question is, what's the true unsubsidized demand for solar really? There's a strong argument that a new, higher than expected floor for demand will emerge because of two powerful trends: rising electricity prices and growing concerns about grid reliability. The real indicator to watch, though, is the solar plus storage market. Recent data shows residential battery storage installations have surged 132% year over year. A market leader like Sunrun now reports that 70% of its new customers are also adding a battery. This suggests the future isn't just about solar panels, but about creating a resilient personal power grid at home. That trend may be powerful enough to carry the industry forward even after the subsidies are gone.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.